Welcome to Just Some Guy Trading with 2021 World Champion Trader Kevin McCormick. Welcome to Just Some Guy Trading. I'm Kevin McCormick, and this is my weekly Trader's Outlook for July 23rd. There won't be an update next week, so I'm going to do a deeper dive into my outlook for the stock market before we jump into the charts. Once we jump into the charts, we're going to take a look at the S&P 500, NASDAQ, and natural gas. As a reminder, this presentation is for educational purposes only. All right, if you haven't watched my stock market outlook for July, I recommend going back and taking a deep dive at that. But this is my record keeping for the third year of the presidential cycle. It's been a great guide for us so far this year. And as I highlighted before, I was expecting a strong start to July, but August and September are not good months for the stock market, historically speaking, during this presidential cycle. So that's one area for caution for us going into the next week. If you did watch it or you haven't yet, here's a heat map of where it was supposed to be good and bad for the month of July. As we said to start the month, beginning of July was looking good, lots of positive days. But this area that we're in now for July is typically when the market starts to roll over. And as we're heading into next week, we have 30% of the S&P 500 reporting. We have some of the big tech heavyweights and a lot of those stocks that have moved up a lot in the last month to 6 weeks, all reporting next week. So we are in an area for caution right now in the stock market. Another update from what we discussed at the beginning of July. Go see the monthly update for the deeper dive. But this rally that we've had from this top to the bottom that was made in October was 195 trading days. And as I noted about a month ago, July 26th will be exactly 195 trading days for the current rally we're in. A lot of these things with the stock market are symmetrical. So that's why I was targeting around July 26th for a healthy correction in the stock market that's quickly approaching for us. And when we jump into the charts, you're going to see a lot of the stuff I talked about lining up possibly for the month of July has now hit with our charts. So going into next week and into July, caution is warranted. If you're still long, like I still have a small long position in the S&P 500 from our Turnaround Tuesday trade, keep those stops really tight because this week we could see the start of a healthy stock market correction. But where do I see this going longer term? Still standing by what I said in the July update and for the second half of the year. I said first half of July is going to be good. Expect a rally. We got that rally. But we now have setups that are showing us that a healthy correction is very possible right now. But in my opinion, all pullbacks are going to be buying opportunities. There's a lot of big money managers who did not have good first halves. So they're waiting for a pullback so they can buy and chase performance into the end of the year. So that's my outlook still for the second half of this year. So with that said, let's take a look at the S&P 500 chart. All right, we're going to start. Cut. 3, 2, 1. We're going to start off by taking a look at the Commitments of Traders report for the S&P 500 futures contract. As I mentioned before, when we had the hedge fund community heavily short here in commercial buying, I said this is going to cause a short covering rally, and we got that move up. But here now we have the commercials selling. And often after a rally that they predicted, this is a good indicator of selling. You can also see this last week. After covering a lot of their short positions, some of the big money managers did get short again, maybe looking at some of the same information we're going to take a look at here. So other than the third year presidential cycle, right now as well, we have commercial selling signal. We have the S&P 500 overvalued against the dollar, gold, and U.S. bonds. Contrarian view on the market. Sentiment is now too high. So this is often a sell signal for us. And the last thing I'm going to take a look at is the seasonal pattern that we've already kind of discussed. Right here on a daily perspective, we should have a flattening and then a move lower heading into the market now. So this is what our area for caution right now with the S&P 500 starting at, end of July. But in addition to this, we have the DeMARK buy and sell signals, or seller exhaustion, buying exhaustion signals hitting as well. So let's jump into those charts and take a look at the DeMARK exhaustion signals we're getting right now. Okay, and as many of you know who have watched my monthly outlook, I had called for us to have some buying exhaustion signals hitting towards the end of month of July. And now we've had them. We had a sequential 13 followed by the combo 13 that just hit this week. Our upside possibility of area of resistance is still up here, but I don't think we're heading that way. I think we're more likely to make a healthy correction down off of these 13s. Just like we had a nice little pullback on this 13, and that gave us the opportunity, great buying opportunity there. Also, here is where we got in on that turnaround Tuesday trade. How far do I think we can fall back? Well, you can see here we have the propulsion exhaustion down marked here. We have a good area of support that's been held here that was recently reset. And a 3 to 5% pullback in the S&P 500 would be a healthy correction. Money's going to come into the market, and that would take us right back to where many of us got long on this great trade that we had to start the month and caught this 5% rally. So it's very reasonable for us to fall all the way back to this level as a possibility. Why are we looking at this and thinking about this? Because one, if we want to get short, we can, but also this way we're not surprised when this happens. I think it's very healthy for us to have a small correction right here, 3 to 5% back into this range. If you have stock investments you've been wanting to make, good time to buy them. As nimble traders, this is a time to be nimble. I don't expect a big pullback here in the S&P 500, but we have so many sell signals aligning. We have timing cycles aligning. We have the 195 trading days I talked about. All these things are all coming together right now. Too many sell signals coming together, in my opinion, for us to not be showing caution and possibly even going short in the S&P 500. Now, let's jump over to the NASDAQ and take a look at what we see there. All right, we're going to start off by taking a look at the DeMARK combo and sequential indicators on the NASDAQ future contract first. As you can see here, our 13s hit earlier on the NASDAQ, which isn't a big surprise because we've had that heavy tech rally, or the Magnificent Seven, as the media is calling it right now. But one of the things I want to highlight here is that, it's always nice when you see these sometimes on a chart with a 13 and a big move down, but these are buying and selling exhaustion signals, which also means we could just go sideways for a little bit. And that's what happened back here with this 13. I did a special report on this 13 and called for it as not a sell signal, but as we're going to move sideways. And we did until we made our next leg higher. And so right now, these 13s have triggered not really a sell-off. This was a nice little sell-off, but more of a move sideways. I believe that this week it's going to change, though. Tech has gone too far, too fast. We have the AI pixie dust that's just, a company names AI and the stock shoots higher. It's not going to be reflected in the earnings. And actually, a lot of these AI investments are going to increase costs for companies right now. And that's going to give sellers the opportunity to sell, rotate into new areas of the market. So unlike the S&P 500, where it just looked like, hey, a small 3 to 5% pullback could happen, and then we could hit that area of resistance. Area of resistance in the NASDAQ could be all the way down here at 13,230. We have a smaller area here, but that's really not much of a pullback. So in my opinion, we could be set up, depending on how earnings go, for a larger pullback in the NASDAQ compared to the S&P 500. And why do I feel that way? Well, let's go take a look at the ADX indicator along with the Williams indicators on the next chart. We're going to start off with the COT report for the NASDAQ as well. Similar setup. As you can see here, the commercials have been selling. They've just moved up a little right here and bought some this week as the hedge funds kind of liquidated their positions. But let's look at this historically. This was a good sell signal. Good sell signals here before we went down. And then back here, you can see as well, we had selling for a while, and I'm going to keep track of this one. This was February 19th, 21, and then we had that pullback as well. But we continued a trend higher going forward. But it was just a small pullback now on the chart, but it didn't feel good at the time. In addition to the COT report, just like the S&P 500, the NASDAQ is overvalued against the dollar, gold, and bonds. When it comes to sentiment, we had our indicator, our contrarian view last week, so kind of similar there. But one of the big differences between the NASDAQ and the S&P 500 is the ADX indicator. If you've watched some of my other videos, you know this is one of my favorite indicators. And when we get over 60 on the way up, it's an indicator that buying exhaustion has been hit and that a pullback is coming in the future. When this aligns with the DeMARK signals, I have over an 80% success rate. So right now we have DeMARK lining up. We have the other indicators I just showed you. And this does not happen very often. And remember that date I just told you, 219? Well, look what happened. The last time we got up above 60, 219.21. And that was that pullback you saw in the COT report. This looks like a nasty pullback, when we were experiencing it in 2021 at this time. But longer term, this was a great buying opportunity. And I think that's what we're setting up for right now in the NASDAQ. So nimble traders, get ready to go short, but book those profits early. This is not something we want to hang on to. And taking a look here, you can see that we're already in the oversold area based on Williams %R for the NASDAQ. And we actually broke our resistance level right here with the Williams will stop on Thursday. So next move lower, if we break this 18-day moving average, the NASDAQ could start moving lower very quickly in the next couple weeks. So keep this in mind for your trading and your investing. Personally, I plan on doing some buying into this sell-off that I expect coming. I was selling into this rally and rebalancing my stock portfolio. And from a trading perspective, still long a little ES. I actually sold some, made a nice little short trade on the Nikkei this week. But I think it's a good time for us to start looking for and taking sell signals in the NASDAQ and S&P 500. Now, let's take a look at natural gas. All right, let's take a quick look at natural gas. As I've mentioned before, I felt like we were starting our basing pattern here in natural gas and that we really needed to start getting some fundamentals to help us out here because the commercials are still heavy sellers of natural gas. But as you can see here, if we do a quick little trend line here, we got a great trend line forming right here. We've made that next move up higher, and we need to hold this support. We just popped above the 18-day moving average on Thursday and Friday. If we can continue to break out higher, I think that'd be a confirmed move higher in natural gas. We have the heat across the United States and the world right now helping us out, causing the fundamental change in supply for natural gas. Everyone always thinks about heating and natural gas, but natural gas is used to produce a very large percentage of electric, and we need that for our air conditioners. So we have a fundamental change in natural gas occurring. And then this week, I was able to get in here and I did my %R buy signal here. Beautiful, nice little trade up to here. And that's the first time we've had the buy signal on natural gas work in a few months. Another sign to me that this market is ready to move higher. So right now, I'm keeping a close eye on natural gas. We need to hold this trend line. Maybe move. I'd like to see us move a little bit higher a couple days this week, then have a healthy pull back to the 18-day moving average and give me another buy signal to get into natural gas. I think the lows are in. We're not going back to these levels in natural gas. And by the end of this year, I expect natural gas to be well over $3, which is a nice move from here. But it's all about when we catch that move because this is a very volatile market. And they call it the widowmaker for a reason. You can make and lose a lot of money quickly in natural gas. So use caution and make sure you have tight stops on any trades you do in natural gas. But longer term, I think the bottom's in and we're moving higher in natural gas this year. Now, let's finish up with corn. All right, let's finish things up with corn. I'm going to take us down the road of looking at the COT report here first as well, because as I've mentioned before, the commercials action in the grain market is very important in my opinion because they're the actual producers and users of the commodity. And as you can see here, when it comes to corn, we've been in this trading range for 18 months now. And the important thing to see here is when we dip down to this level at $4.50 a bushel, commercials come in and buy heavily. This dip, heavy buying, we moved up. Then when we dipped back down again, the buying came in. And here recently, when we got up in this area, commercials sold off some. Then as we dipped, they started to buy again. And then I was planning on pointing out this range to everybody because this is a great trading range for us as traders this week. But then Russia started bombing the ports in Ukraine, and this caused a huge move in corn, wheat, and soybeans this week. I'm preferring corn over soybeans right now because soybeans has had a big run and it has some pretty strong sell signals to it right now. But corn, we can see this range we're in with corn. So I think any pullbacks right now are buying opportunities in corn because you can tell we have producers and users, or more the consumers of corn, are buying at these levels. So we have a floor, in my opinion, in the price of corn in these areas. And the weather premium has not been built correctly, in my opinion, into corn right now in the United States. So if we finish up by taking a look at the chart itself, right now we're in no man's land when it comes to Williams percent R. But you can see trend of momentum has started to move up. So if we can get a little bit more of a sell-off a couple days down here, I will be taking a buy signal off of this Williams percent R trade down here if we can get it. Charts looking pretty good. We had this rally and then pullback, but corn is going to be moving higher in my opinion. So look for and take those buy signals in corn. So as I mentioned, next week we won't have a weekly outlook. Stay tuned on Twitter. Shoot me some questions over there or in the comments down below if you want any updates throughout the week. But really, for this coming week, keep an eye on the stock market. If you're still long the S&P 500 like I am, tight stops. Because I do believe the next leg is going to be lower, and take short opportunities in the S&P and NASDAQ and go long corn when we get a little healthy pullback here. But Russia keeps bombing Ukraine. We may not get that pullback we want. In that case, I'll just be staying away from the grain market. Better to be on the sideline than lose money over actions coming from Russia. Thank you to all my followers. Remember to like and subscribe to my videos. And good luck with your trading until next time.